Hello, and welcome back to the module on funding and resolution. In this second recording, we want to take a closer look at the public sources of resolution funding. To recap briefly what we learned previously, the FSB guiding principles on temporary funding needed to support the orderly resolution of a global systemically important bank set out that there are three lines of defense in resolution funding. The first should be internal liquidity sources. The second, then a tapping of private markets. And only as a last resort may resolution authorities tap public sector backstop mechanisms to cover any remaining funding gaps. And we want to have a closer look at these public sector backstop mechanisms now. The characteristics of such public sector backstop mechanisms are set out in the FSB guiding principles on the temporary funding needed to support the orderly resolution of a global systemically important bank. There are three such characteristics that are set out there, two of them explicitly and one more implicitly. The first characteristic concerns the size of such funding. It should be sufficient to cover virtually any liquidity gap. The guiding principles speak even of the failure of multiple GSIBs at the same time. That should be manageable through such a backstop mechanism. The second concerns timing. The backstop mechanism should be capable of being activated within a very short time frame, even intraday if necessary. And that is another point that the Credit Suisse failure confirms. The Swiss National Bank was indeed required to provide liquidity in the amount of several billions to Credit Suisse within the same day. So it was able to execute the liquidity support same day and also in different currencies. The third point, and probably the most important one, it interrelates with both point 1 and 2, is certainty and predictability. Public sector backstop mechanisms should be designed such that market certainty is established, market certainty in the sense that any liquidity outflows from the bank in and after resolution can be covered through temporary liquidity provision. And that will typically have the effect that market stress gets reduced. So ideally, the availability of such a public sector backstop mechanism will already have a preventive effect by reducing liquidity risk to begin with. Now, public sector backstop mechanisms can come in different forms. What we see is sort of two types of such backstop mechanisms in practice in different jurisdictions. One type is through central bank liquidity facilities of a special sort, often backstopped by funds from the Treasury. And the other type is an industry fund that is also backstopped in one way or another. Now, central bank liquidity facilities exist, for example, in the UK with the resolution liquidity framework, where the Bank of England provides the liquidity if necessary, underwritten by guarantees by His Majesty's Treasury. A similar mechanism applies in Switzerland with the public liquidity backstop that is not yet enshrined in ordinary law. It's still pending, but it's hopefully going to be introduced in the coming years, where the Swiss National Bank provides the liquidity, and if necessary, there is a guarantee from the government that would cover any losses should they incur. The second type of industry fund we see in the US with the orderly liquidation fund. The Federal Deposit Insurance Corporation receives a revolving credit line from the Treasury that covers up to 10% of a failing bank's assets during the first 30 days, and then up to 90% of assets once the Secretary of the Treasury and the FDIC have agreed on a plan and schedule for the repayments, and once the FDIC has made a fair value estimate of the total consolidated assets of the bank. We have also an industry fund-based system in banking union or in the EU even more broadly with the resolution financing arrangements and the single resolution fund. We will come back to that later. First, I would like to briefly discuss with you, the role that could be played potentially by ordinary central bank facilities, such as standard monetary policy operations and emergency liquidity assistance. What role can they play in funding in and after resolution? Now, the FSB guiding principles mention that possibility. They say, notwithstanding the existence of a public sector backstop, so sort of in addition to such public sector backstop, a recapitalized firm in resolution could retain the opportunity to source liquidity under a central bank's ordinary facility, of course, as applicable in each jurisdiction and provided that the firm meets the conditions of access to those facilities. Now, standard monetary policy operations and emergency liquidity assistance need to be distinguished, right? Standard monetary policy operations are system-wide operations, so not targeted at individual banks, and they're non-exceptional. And therefore, the collateral requirements that they typically impose are relatively strict. Typically, central bank laws speak of adequate collateral as a precondition for banks' access to these operations. Emergency liquidity assistance, on the other hand, is already an exceptional facility that is provided to individual banks that are unable to refinance themselves through ordinary facilities. And therefore, they come with reduced collateral requirements. However, there are still relatively strict conditions attached to emergency liquidity assistance. It can only be granted to illiquid but otherwise solvent banks. They must still be fully secured by collateral, so they cannot be granted on an uncollateralized basis. They are granted at the central bank's discretion. That's also very important from a resolution planning point of view. And banks must pay interest on any loans received under emergency liquidity assistance. Now, what is the situation in banking union regarding ordinary central bank facilities? Let us first look at standard monetary policy operations. These are, of course, a competence of the European Central Bank or the Eurosystem more broadly, and it pertains to the ECB's mandate, primary mandate, to maintain price stability. Previously, the ECB pursued the policy that it would suspend banks' access to standard monetary policy operations once a bank was declared failing or likely to fail. Now, we have seen somewhat of a change in that policy since March 2026, banks may regain access to monetary policy operations after resolution under certain relatively strict conditions, the most important condition being that the supervisor has to confirm the solvency of the bank. However, of course, the ECB still requires that monetary policy operations or a bank's participation in these operations are collateralized. The ECB does not accept any guarantee that would replace adequate collateral in these standard monetary policy operations. Now, if we contrast that with emergency liquidity assistance in banking union, it remains a competence of national central banks because it pertains more to financial stability rather than price stability, and financial stability remains primarily a national competence. There is an agreement on emergency liquidity assistance that applies and requires national central banks to inform the ECB about emergency liquidity assistance they grant, and from a certain threshold, namely above 2 billion euros, the ECB must also be consulted by national central banks. However, there are 21 different collateral frameworks that apply within banking union, each for every jurisdiction, and emergency liquidity assistance continues to be backed by 21 national budgets. Now, I also would like to highlight a key principle, of course, that applies to both standard monetary policy operations and emergency liquidity assistance, namely that neither form of liquidity support should lead to any absorption of losses or should fund insolvent banks. Should that be the case, there would be a violation of the monetary financing prohibition as enshrined in the EU treaties, and it would lead to the application of state aid control because the central bank would here act upon a government task and not as an independent monetary policy authority. Now, the BRRD is also very clear about the fact that liquidity support through ordinary central bank facilities should not be assumed by resolution authorities. Article 10 of the BRRD says that the resolution plan shall not assume any central bank emergency liquidity assistance or any central bank liquidity assistance provided under non-standard conditions. That is, resolution authorities have to plan for other sources of funding. They cannot rely on a potential possibility of a bank having access to such facilities in the course of its resolution. Similarly, Article 36 of the BRRD says that the valuation for the purpose of resolution, that is valuation 2, shall not assume any potential future provision of extraordinary public financial support or central bank emergency liquidity assistance or any central bank liquidity assistance provided under non-standard conditions. So yes, the possibility may exist, but it should not be assumed that such liquidity support will actually be granted. The reason is, of course, that we are dealing with independent central bank. So there is structural ambiguity, there is wide discretion included here in the decision-making of national central banks when they provide emergency liquidity assistance, and hence this ELA is unsuitable and unreliable in terms of funding in resolution. Similarly, access to the ECB's monetary policy operations after resolution, it still hinges on the availability of adequate collateral. Now, how likely is it for a bank that is failing or likely to fail to still be in the possession of adequate collateral after its resolution? So, most likely, liquidity support through ordinary central bank facilities will not play a key role in terms of funding in resolution. Now, who will play a key role then in the banking union? Now, it is, of course, the Single Resolution Fund, the key backstop mechanism set up within banking union to provide funding in resolution. The Single Resolution Fund can be used for many different purposes. It can be used for both liquidity support. It can also be used for funding or for cover losses of the failing bank indirectly. But let us focus here for now on those use cases relevant for liquidity support. It can, for example, guarantee assets or liabilities, right? So it could guarantee a loan provided by somebody else. It can make loans itself to a bank in and after resolution, and could purchase assets from the bank that would create liquidity and so forth. Now, again, the resolution fund shall not be used to directly absorb losses or recapitalize an institution in resolution. That would not be in compliance with the idea, of course, that banks should not be bailed out. If the Single Resolution Fund is used in a way that indirectly results in loss absorptions, then certain safeguards apply. And here you see how important it is to make the distinction between purely liquidity support to an already solvent bank, support that indirectly absorbs losses at the bank under resolution. Now, what are these safeguards that apply in the latter case? Article 27 and 76 of the Single Resolution Mechanism regulation set out a loss absorption waterfall. The first line of defense here is internal loss absorption. You're very well aware of the 8% bail-in rule. First, losses must be absorbed by at least 8% of liabilities and own funds of the bank under resolution. Only then can, as a second line of defense, the Single Resolution Fund come in with a contribution of up to 5% of liabilities and own funds of the bank. And then, as a third line of defense, more bail-in may be needed or other alternative public and private financing. Now, how is the Single Resolution Fund funded and how big is it? It is funded from credit institutions and certain investment firms. That is, it is in accordance with the FSB key attribute, a privately funded fund through ex ante contributions. Now, the target level of the fund is set at 1% of covered deposits. The fund had to meet that target level by 2023, and it did meet that target level by 2023. During an initial period, these contributions were collected still through national compartments in the individual member states, and these compartments were over time mutualized until after 5 years. In 2023, they were fully mutualized. You see that on the infograph on the right-hand side of the slide. Now, the status quo beginning 2026, the Single Resolution Fund has collected more than 81 billion euros. That is significantly more than was originally anticipated. It, of course, has to do with the fact that banking union has grown in the meantime, and it has to do with the fact that the size of the fund is dynamic. It is a percentage, and so there is not an absolute cap, but a relative target level involved here. Because the target level has been met in 2023, no contributions were raised from banks in banking union in 2024 until this year. In 2027, the Single Resolution Board will reassess whether a further collection of contributions is needed. In addition to these ex-ante contributions to this target level, ex-post contributions can be raised from banks to cover additional losses that could be incurred through resolution actions. Now, you remember international standards say, backstop mechanisms should be sufficient in size. Now, the Single Resolution Fund is hardly sufficient for the banking union with a target level of 81 billion, even if ex-post contributions could be raised over time. And therefore, it was agreed by the Eurogroup, the members of the European Stability Mechanism, that the ESM can backstop the Single Resolution Fund as a last resort by providing a revolving credit line, something similar to the arrangement in the US with the revolving credit line that the FDIC receives from Treasury. Now, that revolving credit line was agreed to be capped at a maximum capacity of 68 billion. And it was agreed that this arrangement should be fiscally neutral, at least over the medium term. So this common backstop, as it is called, is designed to be repaid by the banking industry via the Single Resolution Fund. So any losses that should be incurred on that liquidity provision will not be a burden for national budgets, but it will be recollected from the financial industry over time. Now, I said before, the common backstop was agreed. Indeed, the countries subject to the ESM signed the according ESM treaty amendment already in January 2021. But Italy, as the only remaining member, has not yet ratified the reform. So currently, the common backstop is not yet in place, and it is uncertain at what point in time it will be. Well, anyway, we can ask ourselves the question, would the banking union backstop mechanism, is it in line with the international standards? Does it meet the requirements set out there? In terms of size, if you add the amounts, collected through the Single Resolution Fund and what could be provided in terms of credit line from the ESM, you reach a relatively good sum with 100 billion euros. But is it enough for a European G-SIB? If we think about the Credit Suisse case, the answer is probably no. So in very extreme scenarios, even that sum may not suffice to cover any funding gaps. In terms of timing, the governance of the Single Resolution Fund and the European Stability Mechanism is very complex. And the use of Single Resolution Funds funding requires the approval by the Commission, it requires the approval of the Council, and it raises the question of whether liquidity will indeed flow fast enough. If we are talking about intraday here, there might be some obstacles due to the governance of the entire arrangements. And then thirdly, is the arrangement credible? Is it predictable for markets? Well, any ESM country could, at least in theory, veto the use of the common backstop, right? The principle of unanimity applies here. The question is really, does this governance lead to sufficient certainty about the availability of funds? Will it really ensure that runs on the bank are, to the extent possible, prevented? That indicates to us that an even bigger necessity, that we have an even bigger necessity in banking union to plan for other forms of liquidity and not rely necessarily on this backstop mechanism. And that will be addressed in our next recording. For now, this is it. Thank you very much for your attention.